and welcome back to Nolan Financial Radio. My name is Tara Nolan from Nolan Financial. If you're new to the show, welcome. We're always glad to have new listeners. This show is all about giving you good questions to ask. There is no limit between the internet and TV marketing and all the different sources coming at you all the time. There's lots of information. It's all about how do you filter that information and say, okay, that's what I need to do for me. And so we have a lot of fun with the show and getting into that. If you have a question, please feel free to give Chris and I a call at 719-210-4242. Also visit our website at www.nolanfinancialpartners.com. While you're there, you can actually visit the radio page. We record these shows and you can go back and figure out like, what's your question? Do you have a question about Social Security or maybe Medicare or 401ks or a TSP? So there's a lot of topics that we cover. If it's something financial, we've probably talked about it, because at Nolan Financial Partners, we really think that your financial world it's a holistic thing. And people tend to look at their money in like stovepipes and have, here's my insurance and then here's my 401k, and they're all separate, and you miss out on that synergy if you're not looking at like, is everything working together to help accelerate the way your wealth grows? Because, I was talking about it earlier, is we're all taught to kind of trade hours for dollars, and that keeps you on a flat scale. And we're always looking for ways to give your money more than one job so that you start to accelerate how you grow your wealth. But we're going to be talking today about RMDs. So this is going to be one of these shows where you're going to want to listen up. If you have a pen and paper, get it out, because we're going to give you good things to take notes on. And this is one of those shows where you have information and you have to go, hey, you know what? I'm getting close to that age. This might apply for me, so I should know these things. Yeah. But before we get into this any deeper, let me say, Tony, how are you doing?
I am doing great. I've had a great week. It's been a good one. Just been keeping really busy between, really just with work. I haven't had any time to do anything around the house because I've been so busy working, but that's good. That's good. It keeps me out of trouble. And but I do love doing the show each week with you. I look forward to this. So this is always fun. We have fun with this. How about you, Tara? Are you and Chris keeping busy there?
We are, Tony. So we are in the launch ramp up now for the book. So the book is now back from the proofreader. So it's going to the typesetter.
Awesome.
The launch date is set for March 29th. And so things are starting to happen quick now.
Just a little over a month away. I can't wait. And for our listeners out there, they'll be able to go to Amazon.com and get the book, and they'll be able to get it directly through you. I know we're going to have a special offer for our listeners. Some of our listeners will be able to get a complimentary copy of the book once it's ready to go. So I think that's awesome, Tara. I can't wait.
It's really getting exciting. So that's kind of where we've been. And it's a good time because the weather's not great. So I haven't been riding as much as I would like to, but I'm really hoping to really start getting back on Ava and get that going. Donzer had to retire this past year because of arthritis. So it's really frustrating because his brain works well and his body is good. He's got arthritis. And what do you do about that?
Yeah, that's tough. That's tough. And that can happen with horses. And it's tough because they are such big animals. It complicates things even more than it does for a person in some sense. I mean, you definitely can't ride them at that point. So the horses, I don't know if they look forward to the spring and being ridden again, or if they've really enjoyed getting fat and happy over the winter, right?
I think they enjoy being fat.
Yeah, I think so too. They get that fuzzy winter fur and just eat and hang out. They probably enjoy that. Although some horses, depending on the age, they like to get out there and run and spend time with you as well. I know how horses work.
Yeah, especially if there's a treat involved.
Yeah, well, of course. Yeah, treats. That's right. You get the old sugar cube or apple or something there. So, but Tara, what are we talking about on the show today? You had an odd topic, I think, for us today.
We are going to zero in on RMDs, required minimum distributions.
Right. Or as I say, really massive donut. RMD.
Right.
That's what it stands for, right?
Stop putting out that disinformation.
Or remedy. I saw RMD and I'm like, does that say remedy? Rimmed? No.
And so again, I will say, if you've got some pencil and paper, get it out because there's going to be some notes today. So, because retirement, Tony, we talk a lot about, like we're talking about Social Security. We talk about early retirement for Social Security at 62. And a lot of people in their head go, well, 65, that can trigger Medicare, right? And then with Social Security, there's also, usually for most people now, your full retirement age is about 67 and a half. And then there's this RMD thing, which has now just changed to age 72. And this is when all of that money that you think is yours in your traditional accounts, now you're going to have to pull the money out so you pay taxes, required minimum distributions. So this is where you get to that point where you go, well, I don't need that money. And it doesn't matter because of the account that it sits in, you have to pull that money out.
So all of those accounts that you were able to contribute to tax-free and have been growing tax-free, those tax-deferred retirement accounts like traditional IRAs and traditional 401ks, what you're saying is at some point, the government's going to make you take money out of them, even if you don't need it, because they want you to start paying full taxes on that money.
That's exactly right, Tony. And that's the whole thing with the IRS has never been your friend. They let you put that money away tax-free as it's growing because it's not very much, with the idea that as the accounts have gotten big, when you're 72, there's going to be these required minimum distributions that you then pull out and pay taxes on. And so it's always this debate because, you know, for me as a financial planner, I'm always trying to set people up to get them in a tax-free situation at retirement. And in a CPA's function, they're trying to save you money in taxes today. So while you're working, especially when you're making a lot of money, it can be very enticing to put it into a traditional account because you don't pay taxes on it today.
Right.
And sometimes we forget, but you will pay taxes. Like there's not ever a situation where you just don't pay taxes. It's kind of the question of, do you want to pay them today or do you want to pay them later?
Yes, that's the question. And, you know, talking about RMDs, I find it interesting because I think a lot of people maybe know in general terms what a required minimum distribution is, but that doesn't mean the reality of RMDs when we turn 72 isn't a rude awakening. It still will be for most people. And so I'm glad we're talking about this.
Well, I mean, like, I think we've done this before, Tony. Just a simple example is if you have $100,000 in a traditional account, about 20 to 30% of that, depending on your tax bracket, is the government's money. So you really only have about 70 or 80,000. And that's a little shocking when you've come to feel like it's yours. And,
that's true.
Tony, I have the similar example is I live on, my initial property was 13 acres and I had 10 acres on either side of me. And someone recently bought last year the 10 acres north of me. And it was frustrating because I was like, well, that's like my place. Nobody lives there. And now there's somebody living on my place.
Yeah. But you didn't own that land.
I didn't own that land, but I kind of felt like it was mine because no one was bothering me. And I had like there was no one on that spot. And so I think that's kind of how it feels when you have a traditional account is you have 100,000, you see it on your statements, you feel like you have 100,000.
Yes.
And then all of a sudden you're like, but that 30,000, why are you taking that? Because I feel like that's mine.
Yeah, exactly. And so obviously when you turn 72, at least they bump the age up a bit so you can leave it in there a bit longer, but at 72 you have to start taking required minimum distributions out each year. And I don't know if that age 72, I guess that's just what Uncle Sam figured out was the age, right? The IRS.
It's better. I think 71 and a half was always confusing.
Yes, the half. I love that, just to make the math more confusing.
Right. And so I think that makes a little bit better. But for people listening, if you don't know, and here's what I'll just tell everybody, there's no reason that you should just know this off the top of your head. So your takeaway from today's show is to go, RMDs, required minimum distributions, are a thing. Do I have accounts that are going to be affected by this? So that you know to go ask that question and make sure you've accounted for it. But Tony, this can be traditional IRAs, simples, SEP IRAs, 401ks, 403bs, 457s. Basically, if it doesn't say Roth in front of it, it's probably a traditional account and you're probably going to be paying RMDs.
Yep.
And
Yep.
here's
And
the
you're going to have to pay
takeaway.
taxes. You're going to have to pay taxes on all that money at some point, right?
Correct.
Yeah.
And this is one of the things when I talk about tax planning from a financial planner perspective is just like you said, you're going to pay taxes at some point, but if you control it right, you kind of get to pick when you're going to pay those taxes.
Yeah.
And so as a financial planner, when I'm looking at your whole life, I'm going, when is it going to be better for us to pay the taxes now or pay the taxes later? And then we have that conversation with the CPA to figure out what's really going to work the best. But
yeah,
there's no magical thing such as I'm not going to pay taxes. Right. But if you plan correctly, and this is what I do with my clients, Tony, is we look at it and go, how do we set you up today early so that we can get you as close to tax-free in retirement? Because, there's the thresholds with how much money you make and how much money you pull out of your retirement accounts. So if you structure your retirement accounts correctly, then it doesn't look like you have that much taxable money.
Right. There you go.
That's what we want to look at is you can't get everybody to zero, but there's a lot of people that when I sit down with them, Tony, and look at how they structure their accounts and how we convert things to Roth and how we manage it, that they end up not paying money in taxes because they're below the threshold because you pull money out of your Roth IRAs. That doesn't count. You don't have to pay taxes on that.
Yeah, nice. Yeah, the Roth IRA is a helpful thing, but you need to work with a financial services professional to deal with that. Now, you had said you were talking about RMDs and how they apply to things like traditional IRAs, simple IRAs, SEP IRAs, other retirement plans like 401ks and 403bs. RMDs are taxed as ordinary income. You mentioned that, but let's talk about if you delay your first RMD and the rules behind it of when you have to take it. So I think if you turned 72, let's say in March of 2021, you actually have until April 1st of the of this year to take your first one. So that first RMD, they give you a little extra time. It doesn't have to be taken within the calendar year. Am I correct on that?
You're correct on that right now. Yeah, exactly.
Yeah.
So this is why it's really important because we talk about, in the growth phase of your life, I'm thinking about the bell curve. It's all about you trying to get rate of return, ROI, all those good things. When you are on the backside in retirement, you want to look at how you spend your money.
Sure.
So you have your accounts, but you want to look at how you spend it because, Tony, if you take the one RMD or delay it and then you take the other one, depending on how the size of it and how much money you take out, you can actually bump yourself up into a higher tax bracket because you took out more money than, there's just the threshold. So if you bump yourself up above a threshold, then it's frustrating because you take the money and then you have to pay more taxes.
Yeah, exactly. So this is where we get into the weeds, Sarah, and where I think our listeners really need to be working with somebody like yourself to sit down and say, hey, how can I plan out these RMDs to really minimize my tax burden as much as possible? And of course, your answer is going to be really that's something you should plan for pre-retirement because then you'll have a plan in place to maybe convert some to a Roth. But if you're already at that point where you have to start taking RMDs and you haven't converted money into a Roth and stuff, that's where you're going to get into some tax trouble. And really, at that point, you got to have professional help with this.
You want to have that, Tony. And here's the thing is if you haven't planned and you find yourself at 72, you do want to take your RMDs because if you don't take your RMD, then there's a penalty.
Yikes. And it's a big one too, right?
It's a big one, right? So bite the bullet wherever you are, do what you got to do, but it's always good. This is the time to go, I need to go and see what my situation is. And so, Tony, this is where a great spot just to let everybody listening know, if you have your accounts and you're not sure the order of spending them and what if RMDs are going to force you into tax brackets that you don't mean to be in, give Chris and I a call, 719-210-4242. Because Tony, Chris and I will sit down and look at what accounts that you have and look at where you are and make sure you're planning to spend your money the right way. It's not just about growing your money, but are you spending it the right way? So that number is 719-210-4242 to book that complimentary discovery call where we can walk you through how we could set you up for success. Because you don't want to pay more taxes than you have to because you didn't know what the rule was.
Right. Exactly. You want to minimize the tax burden. And I know that you and Chris work alongside CPAs to help your clients minimize that tax burden and hopefully plan ahead for this by maybe making some Roth conversions when taxes are low and just paying tax on the seed rather than on the full crop, as you always like to say. So
Exactly.
I think that's a good one. Now, as far as getting a hold of you, you gave the phone number, but you've got a great new website. What's that website address?
Oh yeah, Tony, the website's fabulous. It's www.nolanfinancialpartners.com. The book launch company I'm working with, NG Enterprises out of Denver, they just designed this beautiful website. It's like a piece of art. They are a fabulous part of my team.
That's
really glad
awesome.
to have them.
Yeah, that's cool. And they're right here in Colorado. I like that.
They are.
Yeah, and they did a great job. So that's the website, nolanfinancialpartners.com. Check it out. There's a lot of great resources on the web. Check out the radio page where you can listen to this show, past shows as well. And check out, of course, your YouTube channel. We're here. Every show is, we video every show, and it's available on your YouTube channel. So I want to encourage listeners, there's many ways that they can learn, get educated. And then the bottom line is, though, call you and set up that complimentary, no cost, no obligation consultation. So we're talking about RMDs, and that is required minimum distributions from those retirement accounts, the traditional accounts that grew tax-free. But now you have to take out at least some every year starting at age 72.
And so, Tony, I think we should just take a minute because I know there's those do-it-yourselfers that are listening today. So
Sure.
If you wanted to figure out what your RMD is going to be, irs.gov online is the source for all this information.
Sure.
So, but I'll just kind of walk you through. It's not that complicated. It's pretty straightforward. So what you do is you take your year-end account balance and then you divide it by the IRS life expectancy factor. So you get that at irs.gov, and it's set up by the year of your birthday, right? Because it's based on your age, and it will change every year based on your age. And if you have more than one traditional IRA or other kind of a taxable, some people still have money in their 401ks or whatnot, you're going to calculate an RMD for each account. And so you'll get a total. And then you have the option you can take a little bit from each one of those accounts, or you can take it all from just one account. And so, so this is where we get into some advanced planning with how you spend your money, because Tony, depending on how the market's doing with a lot of my clients are in this phase, we may pull from a green safe money account one year, and then maybe in a different year, we'll pull from the market account. So there's a lot of little moving parts that you can do to really maximize how much money you keep control of.
Sure.
But go ahead.
Well, I was going to ask, and that's important to note, and I'm glad you're going over how this works. But I know 401ks can be a little different at some point. What can you tell us about where 401ks fit into all of this?
Well, 401ks, when you turn 72, are also going to be subject to RMDs. But, the similarities kind of end there, because if you own multiple 401ks, you have to calculate and take each one of those separately.
Ah, okay.
And this is why, Tony, we talk about, and we have shows about it. Once you've retired from your job, it's really best to consider rolling that 401k into an IRA, because then it's about control. When you had a 401k, that was great because the work was doing matching. And so there was things you were getting out of it. Once you're retired, there's no reason to leave your money with that company, because they're still charging you the fees, but they're not giving you the services of providing the matching and doing those things. So when you roll it over, it's about getting it into your control so that you get to make all the decisions.
So really, the answer is you really should have your 401ks by the time you're 72 rolled into an IRA. That's going to make those required minimum distributions and the rules and regulations so much simpler and easier.
It's just kind of comes down to those personality types, Tony, because I know there's the people that just really want to do it themselves. The people that I really help the best, Tony, are the people that go, you know what? I'm enjoying my family. I just want you to make sure that I'm staying out of trouble and I don't have to pay any more taxes than I need to pay. Those are the people that I really like to help, because then I can help them focus on their family and then make sure that we do the best for them and take care of that. And, and you could try to like let things go down to the wire. So the theory being the longer you leave the money in the account, it might grow. And that can happen, right? Especially if it's in the market. But here's the thing. Remember, the money is going to grow, but the tax burden also grows along with it.
Yeah, that's true. That is true. That's a good point. That's a good point.
So you don't have to get so wrapped up about like trying to get it down to like the wire.
Sure.
So just remember, the tax is growing as the account's growing. So basically get it paid on time. Don't get yourself in a situation to pay a penalty.
Right. Yeah. And the penalties are big, and people might be saying, what happens if I don't pay? And we'll talk about that a little more. But first, give that phone number one more time, because you're offering our listeners today a complimentary, no cost, no obligation consultation.
Sure, Tony. That number is 719-210-4242. And Tony, this complimentary consultation is really going to be looking at how do we show you how you're going to spend your money. You've done a good job making your money, but now it's also important to look at how that you're going to spend that money to keep yourself in the lowest tax bracket possible. So that number is 719-210-4242. And you can also book through the website, www.nolanfinancialpartners.com.
All right. That sounds great. Now, during today's show, we've been talking about these required minimum distributions, and they're more commonly referred to as RMDs. And, they don't always get a ton of attention or in information packets and other marketing materials that we see about our finances. But I think the truth is, based on what you're telling us here today, Tara, is that RMDs are an essential part of a lot of people's strategies for retirement. And you noted a couple of times today that missing RMD deadlines can have nasty implications for your finances. You said you got to take it by that time. But so give us a closer look on those potential penalties.
Yeah, Tony, that's fair. So let me just spell it out with some exact numbers so that you can really grasp this.
Sure.
So if you miss an RMD deadline, the IRS has severe penalties because they want their money. And it really can be about 50% of the shortfall. So let me give you this example. Let's just say your RMD was $15,000, but you only took $11,000. So you're going to owe. So the difference there, you were $4,000 short, right? So you're going to owe the government a $2,000 penalty plus the $4,000 that you were supposed to take.
Oh, no.
So
that's terrible.
So it is terrible. And, because you're going to pay the money either way. The question is, can you avoid the penalty? So it's 50%. So it's significant. This isn't a tax. That's a penalty.
Yeah, that's the penalty, not the tax. So really the way to avoid that then is to work with a financial services professional to help you set up a schedule and automatic payments so that does not get missed. And I think that's hugely important. Now, does working past, let's say somebody actually works, nowadays this happens, somebody's still working after they turn 72. How does that impact your RMDs?
Well, that's a great question, because there are a lot of people now, Tony, that are working a little bit longer. And so that's one thing you're going to be able to do is if you're still working after you turn 72 and you don't own more than 5% of the company, right? Because it's a little different for business owners. You can avoid taking the RMDs from your current employer's 401k until you retire.
Ah, okay.
But don't forget, you still need to take the RMDs from previous 401ks that you may still own. Sure. But if your current employer allows the money to be rolled into it, that could be a workaround. So there's different workarounds looking at it. So this is why, Tony, this is why money is so complex, because it's not just math.
Right.
It's what are all the rules? It's like whoever knows the most rules wins, because you think
Right.
it's just about the numbers. It's not. It's about what does
No.
the IRS have to say about it? What does the tax code have to say? So it just gets a little maddening, and there's exceptions sometimes, which are good
Yeah.
and very frustrating if you don't know about them.
Yeah, you could probably read War and Peace 100 times before you'd make it through half of the IRS tax code. So,
Exactly.
now, let's get to the solution for tax problems associated with these qualified, distributions. So the RMDs, required minimum distributions, I should say. So, and based on previous conversations and shows I've done with you, I'm guessing and you mentioned it earlier, the Roth rollover may be a decent option or solution for people, right?
Well, because you definitely want to get it from a 401k, a company plan, into an IRA that you control. Like I said, the 401k is great while you're working, but then once you've retired, you just want to be in control of that money. So and when you do the rollover, if it's Roth, you do Roth money to Roth money, because that way you keep that tax-free status. And then with the Roth, you just remember, if you're at least 59 and a half and you have owned at least one Roth IRA for a minimum of 5 years, then you should be able to use that money tax-free. And I always hate to qualify things, Tony, right? Because the Roth should almost always be tax-free, but you always got to look at the individual. And that's why you want to work with a financial professional, just to make sure that there's not something in your situation that changes it. And so you always want to take a look at that. But another definite thing you want to do, Tony, is look at converting your traditional IRAs to Roth IRAs. And here's where the planning comes into play, right? Because you're going to owe taxes when you do that. So you want to go, do I do that this year? When we have a client, for example, that we just went through this. And so she's going to retire, and we want to do the rollover to the Roth, but we're going to wait with her for a year because we don't want to do the Roth conversion the same year she had a full year's salary. So we're going to wait till she's retired, and then we'll do the rollover when she's retired, because then she's not going to show as much income. So everyone's situation is a little different, but you're going to pay those taxes, but you can spread them out so that maybe you don't get the big tax hit in 1 year. And then and Tony, I've lost your sound.
Oh, that's a great point. I was going to say, but we're out of time for today's show, Tara.
But I have so much more to share.
I know you do. Let our listeners know how they can set up that complimentary consultation and get a hold of you.
So, Tony, the number is 719-210-4242. It's 719-210-4242. And visit Nolan Financial Partners, www.nolanfinancialpartners.com. Tony, this is just so important for the people listening today. If you're in this boat, to come in and we can take a look at it and make sure you have everything, because we want you to reach your maximum financial potential. And the only way to do that is to make sure you've looked at everything and taken advantage of everything you can.
Yep. I think that's great. Good advice. Listeners, pick up the phone, give Tara a call. Great conversation today about RMDs, Tara. Listeners, that does it for today's episode of Nolan Financial Radio.
Join us soon for another episode of Nolan Financial Radio. Take care, and we'll talk with you next time.